XRP is about to shock the world, and what Jake Claver just said might be the most important confirmation we've had yet. According to Jake, XRP will be chosen over XDC and XLM in most cases. And what he revealed about his private meetings with R3 could explain exactly why this isn't speculation anymore. These are conversations with people who are actually building the new financial infrastructure behind the scenes. This is not financial advice. And if you want a full step-by-step breakdown of how XRP's global adoption could play out, every connection, document, and payment flow mapped out in detail. I've put it all together inside the XRP Millionaire Blueprint. It includes video walkthroughs, in-depth analysis, and visual breakdowns of the entire ecosystem. You can find it in the pinned comment below. Let's get into it. Jake Claver recently said something that caught everyone's attention, and it came directly from his conversations with R3, the blockchain company working closely with banks and institutions on enterprise settlement systems. When Jake asked them how settlement would work and whether they should make their system interoperable with XRP or XDC, R3 told him point blank, "We will only settle through something that has regulatory clarity in the United States and enough liquidity to settle, period." And what asset fits that description? XRP. What Jake is saying is that R3 themselves confirmed that they would not use any asset in the US for settlement that doesn't have legal clarity. That means XRP stands alone as the only digital asset that fits the criteria. And while Bitcoin may have been labeled a commodity by regulators, it's not designed for settlement. It's slow, expensive, and not optimized for the kind of institutional scale transactions that R3 and its partners are building for. XRP, on the other hand, was literally created for fast, cheap cross-border settlement, and it's the only asset right now with a clear legal standing in the US. So think about what that means for the future. If the United States government is preparing to move toward blockchain-based financial infrastructure, the only viable settlement asset they can use legally and technically is XRP. That's why Jake floated the idea that Ripple could even gift a version of Ripplet, their settlement software, to the US government for use in a national payment system. Because remember, Ripple software is just code. It's modular, adaptable, and scalable for any institution. Picture this. The US rolls out its new blockchain infrastructure. Banks and financial institutions across the country are granted permission to plug into it. Settlement happens instantly through XRP. That would effectively leapfrog the outdated legacy systems we've used for decades. And this isn't a fantasy. It's a logical move that fits the direction we've seen the government and financial sector heading over the last few years. Ripple recently applied for a banking license, which would give them direct access to the Federal Reserve System. That's a massive step forward. It means Ripple could settle directly with the Fed, bypassing layers of intermediaries. Combine that with the clarity XRP has, and the partnerships Ripple has built globally, and the puzzle pieces are aligning exactly as many predicted. After the legal battle came to an end, the regulatory floodgates opened. Under the new administration, digital asset innovation became a top priority, and blockchain clarity became part of official US policy discussions. In multiple reports and working group documents, both Bitcoin and XRP were explicitly mentioned as recognized digital assets for future infrastructure testing. Then came the international meetings. Ripple, Coinbase, Circle, and other top crypto players sat down with government and banking leaders at Downing Street for transatlantic financial cooperation talks. You had representatives from Barclays, Citi, and HSBC in the room discussing blockchain integration and cross-border payment modernization. The presence of Ripple in that conversation speaks volumes. Now looking ahead to 2025, Ripple's banking license combined with the clarity XRP already holds positions it as the #1 candidate for a national blockchain settlement layer. If the US government is even considering a blockchain-based system, XRP is the only legal and liquid option. That's why the Clarity Act that's moving through Congress right now matters. But until it's passed, XRP remains the only digital asset with full legal clarity in the US. Now, let's talk numbers because this is where Jake Claver's theory starts to get really interesting. According to Jake, if the only major catalyst that plays out this year is ETF approval, meaning Bitcoin, and possibly other digital asset ETFs get launched, XRP could realistically move into the $10 to $13 range, possibly touching $20 to $25, depending on how much institutional liquidity floods in. Those numbers are based on actual liquidity inflows, not hype. And that's before considering any of the other massive catalysts on the horizon, such as global settlement adoption, central bank integration, or the potential launch of national blockchain payment rails. What Jake's saying is that there's a perfect storm scenario that could send XRP much higher. But even under conservative conditions, just ETF adoption and baseline liquidity, a double-digit XRP is entirely plausible. Recently, XRP saw its biggest long liquidation since September 2020, with over $17.7 million in positions wiped out. Within hours, the market reversed, and we saw a $5.8 million net inflow. What does that tell you? Institutions are moving in and out of positions strategically, shaking retail. Investors out before loading up. They know how to exploit volatility while clarity is still in progress. And until regulations fully lock into place, that kind of behavior is going to continue. But the important part is that liquidity keeps returning. The long positions come back, inflows increase, and the base price slowly rises again. That's accumulation, not capitulation. Then we have the DTCC, the Depository Trust, and Clearing Corporation, the organization that literally handles the settlement of nearly all securities in the United States. They just put out a statement saying blockchain and asset tokenization are transforming the financial system by replacing costly intermediaries with faster, more transparent processes. They said tokenized assets will enable fractional ownership, instant settlement, and built-in compliance through smart contracts. If you understand what that means, it's game over for legacy infrastructure. Instant settlement and tokenized assets directly connect to the type of systems Ripple and R3 have been building for years. And with R3 publicly confirmed to have chosen the XRP ledger as its base framework, it's not hard to see where this is going. Ripple's network combined with R3's KOA platform is already integrated with major banks, custodians, and financial intermediaries. The future of stock settlement, bond settlement, and cross-border liquidity could all converge onto these systems. That's why XRP is uniquely positioned. It's not just another crypto token. It's the bridge that connects old finance to new finance, and the pieces are already moving into place. Even the World Economic Forum has acknowledged that we're entering a second wave of blockchain adoption. The first wave was experimentation. The second wave, the one we're in right now, is institutional adoption. Banks like Standard Chartered, Citi, BBVA, Deutsche Bank, BNP Paribas, HSBC, State Street, Visa, and Goldman Sachs are all part of this new phase. These are trillion-dollar institutions quietly building their blockchain rails behind the scenes. And here's what's wild. We're already seeing early signs of real-world liquidity commitments. Trident Capital alone has pledged $500 million, Weeb is $300 million, Vivo Power $121 million, and Vogistics $50 million toward XRP-linked infrastructure initiatives. Hyperscale, Workport, and others are adding millions more. Even Reliance, one of the largest corporations on the planet, recently added another $17 million commitment. These aren't random investments. These are liquidity plays for future on-chain settlement. Every one of these corporate commitments adds another layer of liquidity and credibility to XRP's network effect. And this is just the beginning because, as Jake Claver and Coin Club Quincy both point out, people constantly misunderstand what actually drives value for assets like XRP. Everyone focuses on total supply or market cap, but those numbers don't determine value in a utility-based network. What matters is volume. How much value is flowing through the network, and how much of that value needs to be settled using the native asset. Jake explained it perfectly. When it comes to digital assets that act as settlement layers, The real driver of price is not how many tokens exist, but how much transactional demand exists for them. Think of it like oil. The total amount of oil in the world doesn't directly set its price. What matters is how much oil is being traded. The higher the trade volume, the higher the demand, and therefore the higher the price. The same principle applies to XRP. The more value that moves across the XRP ledger from tokenized assets, remittances, and cross-border settlements, the greater the demand for XRP liquidity. Institutions, banks, and payment providers will need to hold XRP to settle those transactions, and that demand scales directly with transaction volume. CoinClub Quincy added another crucial insight. In crypto, people get too hung up on how many tokens exist or what percentage is circulating. What really drives the value is the velocity of settlement. How often XRP is being used as the intermediary asset in global transfers. He explained that if you look at traditional commodities like oil or gold, demand is measured by trade volume. In the world of digital settlement, that trade volume comes from tokenized assets being exchanged on-chain. Every time a tokenized bond, stock, or currency gets traded on a blockchain that settles through XRP, that creates utility-driven demand. So when you start combining global trade, tokenized securities, and central bank digital currencies, the amount of value moving through XRP's rails could reach astronomical levels. This isn't about retail speculation. It's about real financial infrastructure shifting to on-chain liquidity, and XRP sits right in the center of it. This is why the conversation around the DTCC, the organization that clears and settles nearly every stock trade in the US, is so important. They've already confirmed that blockchain will underpin the future of settlement. Their pilot program, Project Ion, has been quietly processing transactions for months, and their most recent patent filings mention XRP, XLM, and a few other networks as potential settlement assets. That means we're no longer talking about theory. We're talking about actual institutional blueprints being filed and implemented. The transformation of stock market settlement is underway, and the timing aligns perfectly with Ripple's ongoing expansion. R3's network integrations and the IMF's mention of XRP as part of sovereign stablecoin initiatives. If you connect all these dots, R3's enterprise blockchain built on XRP technology, Ripple's new banking license, the DTCC's move toward tokenized settlement, and the IMF's acknowledgement of the XRP ledger as an institutional-grade system. It paints a very clear picture. The world is converging toward a blockchain-based settlement system, and XRP is in the lead position. Now let's step back and look at the macro picture. The World Economic Forum laid out a multi-wave model for blockchain adoption. The first wave was proof of concept experimentation, small pilots, early fintechs trying out cross-border payments. We're past that. We're in wave 2, the institutional adoption phase. This is where the largest banks in the world step in. Standard Chartered, Citi, BBVA, Deutsche Bank, BNP Paribas, Associate General, State Street, HSBC, BNY Mellon, JP Morgan, Goldman Sachs, and MasterCard are all publicly building or testing blockchain systems. Many of them are already R3 partners. Some are Ripple partners, and nearly all are connected to pilot programs involving digital settlement or tokenized assets. That's not coincidence, it's coordination. Think about how long it takes for large financial institutions to move on new technology. They don't adopt trends, they prepare infrastructure years in advance. And right now they're preparing to move trillions of dollars in assets to tokenized ledgers. When those assets begin trading on-chain, they'll need liquidity, instant scalable liquidity that can move across borders and between currencies. That's exactly what XRP provides. And here's what most people overlook. XRP's role isn't just as a bridge for remittances, it's a universal settlement token that can be used for any tokenized asset, bonds, equities, real estate, commodities, derivatives, anything represented digitally on a ledger. That's the scale people underestimate. When you hear about banks like Santander, PNC, or Bank of America testing Ripple's technology, or when you see R3 expanding into tokenized bond markets, those aren't isolated experiments. They're part of the same infrastructure shift. Now, one of the most revealing documents surfaced through community research earlier this year, confirming that the IMF listed R3's blockchain infrastructure as being based on the XRP blockchain for sovereign stablecoin issuance. The document explicitly mentioned that central banks were planning to issue stablecoins built on R3's XRP-based architecture by 2022, with expansion expected in following years. That's significant because it shows that international monetary bodies already recognize XRP's network as compliant grade and scalable for national level usage. When a system reaches that level of recognition, it's not a matter of if, it's a matter of when governments start leveraging it. And as we move closer to 2026, the timing couldn't be better. With regulatory clarity now established in the US, Ripple's license application pending, and international alignment underway, the world's financial plumbing is being quietly rebuilt on blockchain rails. Meanwhile, corporate adoption continues to climb. The list of companies committing liquidity toward XRP-related projects keeps growing. Trident Capital's $500 million commitment, Weebis's $300 million, Vivo Power's $121 million, and several others represent billions in total capital earmarked for on-chain settlement systems. That's not retail speculation, that's corporate allocation. Every dollar committed to XRP infrastructure represents future transaction volume, and every transaction requires XRP liquidity. The higher the volume of tokenized assets being settled, the greater the price pressure upward on XRP's limited supply. And that's what Jake Claver means when he talks about the perfect storm. It's not a pump scenario, it's an economic inevitability. When institutional settlement moves to blockchain, liquidity demand will exceed available. Supply and price adjust accordingly. You can already see early indicators of this shift. Liquidity corridors are forming globally in Europe, the Middle East, and Asia, where Ripple's partners are linking regional payment systems using XRP as the bridge. That's happening quietly, but at a massive scale. Now add ETF adoption into the mix. Once institutional-grade investment products open the door for large funds to gain XRP exposure, the volume will explode. Remember, ETFs bring regulated capital, pension funds, endowments, family offices that previously couldn't touch digital assets. If even a small percentage of that capital flows into XRP, once these funds launch, you're talking billions in daily volume. And as Jake noted, even just with ETF-driven liquidity alone, XRP reaching $103 becomes entirely reasonable, possibly even $20, $25 if multiple catalysts overlap. Those aren't speculative targets, they're liquidity-based projections rooted in transaction modeling. Meanwhile, on the ground level, Ripple continues expanding partnerships across remittance corridors, FX markets, and tokenization pilots. They are setting up interoperability frameworks with payment networks that already process billions per day. Every one of those networks represents future settlement volume. This is why institutional players are loading up early. They are not waiting for full rollout. They're positioning themselves ahead of time. The moment large-scale settlement begins, XRP liquidity will become the most valuable commodity in the digital economy. And if you think that sounds far off, look at the timeline. Ripple's banking license connects them directly to the Fed's instant payment system. The DTCC is rolling out blockchain settlement for securities. R3's Corridor platform is expanding integration with financial institutions worldwide. The IMF has already validated the architecture, and governments are openly discussing national blockchain payment systems. All of these roads converge at one point: settlement. And the settlement layer needs an asset that is legally cleared, liquid, and technologically ready. There's only one that fits that description right now: XRP. As more countries adopt digital currencies, interoperability becomes the next frontier. That's where XRP's design shines. It doesn't compete with CBDCs, it connects them. Each country can issue its own digital currency, but they'll still need a neutral asset to bridge value between them. That's XRP's entire purpose. The deeper you look, the more the picture forms. Ripple builds the technology. R3 builds the institutional framework. The DTCC handles securities. The IMF and WEF shape international policy. and XRP sits quietly underneath, waiting for the flow of trillions to move through it. The pieces aren't random, they are connected globally, strategically, and inevitably. And once the infrastructure goes live, the price will simply reflect the utility being demanded by the system because, in the end, price is just the visible result of liquidity demand. That's why understanding Jake Claver's insights is so important. He's not just talking theory, he's sharing what insiders at R3 have said behind closed doors, that they will only settle through assets with legal clarity and liquidity. That eliminates 99% of crypto and leaves one clear path forward. It's the same path Ripple has been building towards since 2012, a bridge asset that connects every currency, every network, and every form of value on the planet. And that's exactly where we are heading. The truth is, what we're watching unfold with XRP is not just another crypto cycle. It's a multi-phase transition from speculation to infrastructure. Every sign points to a digital asset that's evolving from retail hype into the backbone of institutional settlement. And Jake Claver's prediction that XRP could move into the 20 to 25 range under the right macro and ETF conditions doesn't come out of nowhere. It's a reflection of how deep this transformation could go once the major players are allowed to step in fully. Because here's the bigger picture most people miss. Institutional adoption doesn't look exciting in real time. It's quiet, it's regulatory heavy, and it's built behind layers of compliance and pilot programs. When a central bank, hedge fund, or multinational corporation tests something like XRP for settlement, it's not going to show up on the charts right away. These entities run internal trials, evaluate speed, cost, and liquidity, and only move public once the infrastructure works seamlessly. By the time retail investors notice, the bulk of the positioning is already done. And right now, there's something brewing beneath that surface. Ripple has already announced multiple partnerships across Europe, the Middle East, and Asia, corridors that collectively represent trillions of dollars in annual remittance volume. The UAE, Singapore, and Japan are setting up frameworks that align directly with Ripple's structure. These regions don't move unless they see long-term potential and political stability, and that's what XRP brings to the table, an asset that can move value instantly without being pegged to one nation's economy. Now, consider the coming introduction of spot XRP ETFs. We are not talking about a meme token getting listed on a new exchange. We're talking about institutional access, funds, retirement portfolios, hedge capital being able to legally and directly allocate into XRP exposure. When that door opens, it's not just speculative demand. It's regulated liquidity, entering an asset with fixed supply, and burning mechanisms on every transaction. That's the moment supply shock becomes real. Because while the retail market trades XRP between exchanges, Ripple continues to lock up large portions of escrow supply, releasing them slowly and strategically. If institutional demand begins to ramp while circulating liquidity tightens, price discovery will no longer be linear. It'll move in exponential surges, just like what happened with Bitcoin post ETF approval, only faster because XRP's total supply dynamics and settlement utility are far more concentrated. Jake Claver's projection of 10-13 tails for the realistic move and 2025 for the ETF-driven scenario isn't just optimism. It's a calculation based on capital flow potential once liquidity corridors begin linking between institutions. Think of it like plumbing. Once all the pipes are connected and the valve is turned, the pressure equalizes rapidly. In XRP's case, that pressure is capital waiting to move through compliant on-ramps. We are heading toward an environment where cross-border settlement no longer depends on outdated systems like SWIFT. Ripple's reach is expanding quietly into banking backends, remittance firms, and even government-linked financial networks. And once CBDCs, central bank digital currencies, start operating on interoperable rails, XRP becomes the bridge asset connecting them all. That's when volume skyrockets. And that's when prices stop behaving like typical retail-driven charts. It's important to see that the next bull run for XRP might not look like the last. It won't be about hype, it'll be about integration. When global remittance networks, liquidity providers, and fintech systems begin using XRP for real-world transfers, the volume charts will move for a different reason, because real money is flowing through. And at that stage, retail investors will only have two choices. Either they've positioned themselves early or they're buying in at a premium once the institutions dominate. This is why analysts like Claver are emphasizing patience and conviction. It's not about timing the pump, it's about understanding the timeline of transformation. The phase we're in now, the accumulation zone, will likely be looked back on as the moment when the financial elite began retooling the rails of global settlement. Ripple's steady stream of partnerships, legal victories, and regulatory progressions are lining up for what appears to be a controlled ignition sequence. When the catalysts align, ETF approval, CBDC integration, and international corridor expansion, XRP will shift from undervalued to indispensable almost overnight. And that's where vision separates winners from spectators. Those who understand how infrastructure level change works know that the biggest gains happen before the mainstream narrative catches up. When the world realizes that XRP isn't just another token, but the settlement layer of the new digital economy, it will already be too late to accumulate at these levels. And if you want to understand the exact framework top investors use to spot life-changing opportunities before they go mainstream, check out the Millionaire Blueprint to position yourself ahead of the next wave of global financial transformation. Information.